The Rebel Capitalist Show.
Going to the economic conversation, there's another thing I've given a lot of thought about, and I've listened to a couple of your lectures on it, and that's the concept of free banking, and then also comparing that to full reserve banking. Because I know some of the Austrians kind of go back and forth and they have different opinions on this. So if you could explain full reserve banking and then contrast that to free banking, and then let us know kind of what you think is the best solution for the banking system itself.
Okay, sure. So maybe I'll do free banking first because I think it's easier to set up what that is, and then to contrast it with 100% or full reserve banking. So, and again, this is all like it's what's probably the single biggest controversy among self-identified Austrian economists at this point is this question.
Okay.
And
Okay.
so the people calling themselves free bankers and the two leading people in this regard would be Larry White and George Selgin. Selgin no longer calls himself an Austrian, but he was steeped in the discipline, and it's more he just doesn't like labels. So they agree central banking is bad. They don't want the government regulating. If they're not all necessarily anarcho-capitalists like Murray Rothbard was, but they definitely don't want special privileges for the banking sector. In other words, whatever rules the government would enforce for pizza parlors is what they do for banks. Just contract enforcement. If you have contracts with your customers, enforce them. But there's no special thing. There's no agency that's getting ready to bail out banks if they get caught with their pants down, things like right. So they're all agreed on that. But they do say one of the things they would, in their view, under laissez-faire property rights, is to say for demand deposits or just checking account balances in the vernacular, somebody puts in a $1,000 deposit, their checking account balance goes up by 1,000, so they think that's their money in their account. But as we all know, as happens nowadays, the banks might lend out 800 of that to somebody else. And the contractual arrangements when you open your checking account would spell all that out. So you would know the bank has the right to do this. It's conceivable if I show up on Tuesday and want all my money, they might have to tell me we don't have it, come back later, right? And they have the contractual right to do that. In practice, they probably won't. They have enough of a reason, but okay. And so and they've developed models showing like what's the optimal reserve ratio that banks would have, because it's not good for business if your customers show up to get quote their money out and the bank doesn't have enough in the vault, right? So the banks don't ever want that to happen, but their point is that's not something that regulatory bodies or the law would pin down. That's just banking practice. Let them determine it. Just like a parking garage, it's not good if every time people go in there, there's never a spot. Like people would get annoyed and they would stop using that parking garage. And so, they could adjust their rates or whatever to try to make sure that doesn't happen. But that's not something you'd want the law pinning down. So
I want to point out they can reference specific times in American history. I believe between maybe 1810 and 1850, or at the start of the Civil War, we had that free banking system here, didn't we?
Yeah, to a greater or lesser extent. Yeah, I think George Selgin likes Canada, what they did in the late 1800s. He thinks more closely approximates, his vision. But yes, at various points in history, it was closer to their vision. So in contrast to that, you've got other Austrian economists Ludwig von Mises. Both sides claim that he's their guy, right? And he's written stuff that looks sympathetic to one versus the other, and we can get into that if you want. But certainly Murray Rothbard and people in that tradition of the subset of Austrians who are really big fans of Rothbard are 100% reserve bankers. And so it's a bit of a misnomer because we believe in free banking too, right? Like, not that we want government regulation of banking per se, but their claim is that it's actually government privileges that allow banks in practice to have much lower than close to 100% reserves. Mm-hmm. And so they think that's actually not a free market phenomenon, that in practice. And so let me just clarify, because some people hear that and they're like, well, how could banks operate? Like, you're a credit intermediary, you've got savers, they put their savings with the bank, and then the bank uses its loan officers to figure out who we're going to allocate the credit to for borrowers, and we're the middleman earning the spread. If we had to keep it all in the vault, how could that? And so there's a distinction among the 100% reservists between time deposits and demand deposits, or checking versus savings accounts. So just think of it: if you buy a CD from a bank, you give them $1,000 and they owe you $1,050 next year. that's not your money anymore. You can't go spend that at the store the way you can spend money in your checking account.
Right.
So you would just delineate those two functions of banking. So for true demand deposits that is in the vault with your name on it, as it were, you might even have to pay a small fee to the bank because they're not earning interest on that. They're just storing it for you as for convenience purposes and safety. So that's their view. And then besides just like the ethics of it or whatever, the important economic issue is the 100% reservists argue the Austrian boom bust cycle is caused by fractional reserve banking per se. And so that's my own view. I used to be what we would now call a free banker, but then the more I read, I switched now to the other side. That I think that what the theory of the business cycle that Mises and Hayek developed, I think is caused. It's not the central bank exacerbates it, but the ultimate underlying fundamental problem is banks issuing more credit than there are genuine savings backing it up.
Right. So with full reserve banking, they're not increasing the money supply. They're not increasing broad money. Whereas fractional reserve banking, they are.
Right. And that's another. So the free banker school or camp, they think, oh no, it's good that banks have that ability, like an elastic credit, because then if the demand for money goes up, instead of having to wait for prices to come down, which can be painful, or to go dig up more gold or whatever, the banks can just issue more notes that are quote unbacked and lower their reserve ratio and automatically satisfy the community's desire to hold more money or near money, let's call it.
Even for productive lending,
Right.
Goods and services. If you have that elasticity in the money supply, if the banks are lending properly, then you could have more rapid productive growth than, to your point, by waiting for the price levels to come back down to where there's enough money for it to go out.
Right. So that's what the free bankers argue in their favor. And then the 100% reservists say on the flip side, no, because the interest rate really means something. And you're not creating more actual resources by printing up banknotes. And so if we all agree that printing up more banknotes pushes down the interest rate below what otherwise would have been, then that's giving a false signal to entrepreneurs. It's telling them there's more genuine savings available than there really are. And that's what we all agree is the essence of the artificial boom in the Austrian theory. So that's the dispute.
Okay, so let's back up a little bit there. So that, if I'm hearing you correctly, their argument, the people who would favor the full reserve banking, is that the problem, although the fractional reserve banking may allow more rapid growth, even if it's done productively, it's still going to have the tendency to create that boom bust cycle, which in the long run is going to create distortions and misallocation of resources and malinvestment. So if you look at maybe the next 2 or 3 years, yes, you'll have higher growth. But if you look over the next 20 years, then you're going to have lower growth because it's going to go up and it's going to come down and it's going to go up, come down. Or if you have full reserve banking, it's most likely going to go up at a more direct trajectory. Is that correct?
That, yes, what you said is perfectly fine. And let me just elaborate a little bit just so you see where they're coming from. Like, let's say, there's rapid growth in certain areas, like in China, a lot more people are driving cars or whatever, and that makes crude oil prices go up. So there's a sense in which you could argue, oh, wow, that's crimping growth in the United States, because now gasoline's a lot more expensive. And, wouldn't we grow faster if we could make oil cheaper? And if the way we did it was we somehow printed up pieces of paper that made people think there was more oil than there were, and that temporarily pushed down oil prices, that you're right, that this quarter GDP growth might be higher.
Yeah.
But if we didn't actually create more oil and we made the price the wrong price, in other words, the rising price of crude means something. It communicates information to the whole global economy to know what the resource constraints are. And so you're not doing any favors by giving people the wrong information, the wrong signals. So you're right, in the Austrian framework, an artificially low interest rate, in a sense, does stimulate short-term growth. Businesses can expand, they can hire more workers, that pushes up wages, everybody feels wealthier, but it rests on quicksand, that it's misallocating the capital structure. And you're right, it might take time for those misallocations to reveal themselves and for everyone to realize, oh, wait a minute, this is unsustainable. But there's certain metrics might look like you're promoting growth, but you're actually doing it at the expense of long-run sustainability.
So how would the individuals who favor the full reserve prevent the free market from creating a fractional reserve system?
Okay, great question. Yeah, so here it's a little bit tricky. And so, like Rothbard in his writing, for example, says stuff like, well, in a libertarian world where the judges, properly applied law the way I, Rothbard, think they should, they would just look at these fractional reserve things and say that's fraudulent. You can't do that. You know what I mean?
Yeah.
So it's that kind of, like, they're viewing it as like if you went into a restaurant and checked your coat and they give you a ticket, and then they went and rented your coat out for 2 hours, thinking, well, no, he's having a long dinner. We can, just as long as we get the coat back before he comes to pick it up, it's fine. And if you found out they were doing that, you'd be outraged, right? So there's that element in this debate. But then, of course, the free bankers say, give me a break. Everybody knows the bank's lending your checking account balances out. There's no fraud going on, right? So there's part of that element. To answer your question, George, I'm not sure what some of the full reservists think should be done right now in the real world. Like, do they want the state to, fine banks for doing fractional reserve bank, or do they want the Fed, for example, to insist on 100% reserve requirements instead of, they just got rid of them last March altogether. So there, I'm not as clear and so different. Like, so for me, I don't want the state doing anything, right?
Right.
So
Yeah.
it's, even though I agree with the economic arguments about the problems of fractional reserve banking, I don't want the state coming in and doing it. Just like I could agree being a heroin addict is not good for you and might cause boom busts in your personal life. I don't want the state, therefore, throwing you in a cage or fining you for using heroin. So, I mean, maybe that's a goofy analogy, but it's something like that for me personally.
Yeah.
But as far as a perhaps more understandable or defensible thing is, they would say, in practice, the reason commercial banks right now have such low reserve ratios is because, for example, the central bank is there as a lender of last resort. So they know if they get caught with their pants down, they can just go to the Fed and get rescued. Like, that's actually one of the original. So they might argue, in a more genuine free market system, naturally the commercial banks would have much higher reserve ratios.